Hello everyone, welcome to my continuing discussion on deferred taxes. Today's topic is going to be to review how you show your deferred taxes on your financial statement. So, deferred taxes with financial statement presentation emphasis. I have two goals today, radical. The first goal is to show how deferred taxes are presented on the income statement. And I'll bet you guess my second goal. Yep, show how deferred taxes are going to be presented on the balance sheet. So let's get started on goal number one, the income statement. First of all, where are we on the income statement? You list all your revenues and your gains, and you subtract all your expenses and your losses from that, and you come up with income before taxes. So you can see we're right down to generating income tax expense. In order to demonstrate this more easily, I would like to make an entry to record a deferred tax and tax expense for a period. I'm not going to show you how I came up with the calculations. I'm just going to kind of make up an entry. Let's say for our business we made an entry that showed tax expense, deferred taxes payable, and taxes payable. And that the taxes payable were $80,000, that the deferred portion was $20,000, and that the income tax expense would end up being the sum of those two, or $100,000. How would that translate to our income statement? Well, under income tax expense, we would show the current portion of income taxes, and we would show the deferred portion of income taxes separately for full disclosure purposes. The current portion is always going to be our current taxes payable, and the deferred portion will be, the current portion is always our taxes payable, and the deferred portion will always be current or deferred tax asset and deferred tax payable netted to one number, so that the total make up income tax expense, and in our case the 80 and 20 will make up the $100,000 of taxes payable. So you have income before taxes, and you'll subtract $100,000 of income tax expense, and then you'll show net income. Let's say our income before income taxes was $250,000. Let's just put a number in there, a little messy. Our income tax expense is $100,000, so our net income's $150,000. It's a little messy up there, sorry, 250. So, you can use our entry to show income tax expense. Notice tax expense ties to the tax expense number, that the current portion is taxes payable, and that the deferred portion would be whatever it takes to get to tax expense or deferred tax asset and liability netted. That is how it would show on the income statement. So you've done that many times, you've just never really had to do the breakout before or spent so much time contemplating where the number came from. Interesting, isn't it? Taxing. That was funny. All right. Well, that takes care of looking at it on the income statement. Requires that you show the deferred versus the current portion. Let's turn our attention now to how it looks on the balance sheet. A fascinating topic. Let me put down some facts. Hold on. Let's assume that the items that gave rise to deferred tax items on our balance sheet are an installment receivable. It's at $125,000. It's a long-term installment receivable. We have some prepaid insurance that is short-term, expires within the next year in the amount of $5,000. 2 assets. Unearned revenue, a short-term amount that will be recognized next year, $2,500. And a lawsuit liability, $187,500, because somebody sued us and we're going to owe them some money, but we figure that's still a few years away. All of these items would give rise to a deferred tax amount. Let's assume we have a 40% tax rate going on all of these. I'm not going to give the journal entry that you would take or make to record this. I'm just going to focus on balance sheet presentation, but I do need to know the tax amounts. 40% of 125 gives rise to a $50,000 tax liability. And since it relates to an asset, it will be a deferred tax liability. 40% of the $5,000 will equal $2,000. And since it's relating to a tax or an asset, it will give rise to a deferred tax liability. Unearned revenue is a liability. 40% of that will be $1,000. A liability gives rise to a deferred tax asset. And the lawsuit liability is also a liability. 40% of that's $75,000. And since that's a liability, it too will give rise to a deferred tax asset. So we have 2 deferred tax liability amounts, one long-term, one short-term, being driven by how the asset is classified on the balance sheet. And we have 2 deferred tax assets, one short-term and one long-term, again driven by how the related liability is shown on the balance sheet. The way that you would show the associated tax liability on the balance sheet is pretty interesting. I'm going to make a little table. I'm going to list my deferred tax assets. Then I'm going to list my deferred tax liabilities. And I'm going to show the current amounts in my current column, and the long-term amounts are non-current in my non-current column. So the first thing I'm going to do is separate my deferred tax assets into their current versus non-current categories. The installment receivable, the deferred tax part of that, is $50,000, and it's long-term, so I'm going to put that in my long-term column, and I've picked that one up. Then I'm going to pick up my short-term one, which is $2,000, and that's a deferred tax liability. Whoops, I'm doing the wrong one. Alright, I gotta put my liabilities down here. Eek. It's not a deferred tax asset, it's an asset I'm looking about. Ignore that scratch. So I have a deferred tax liability, and I put it in my long-term column because it's long-term. And then I have a prepaid insurance that created the deferred tax liability that will revert next year. So it is short-term. Not because it reverts next year, but because the asset it relates to is short-term. Now it's time to do my deferred tax assets. My unearned revenue is a short-term liability, so I'll sort that into the short-term column. It's a credit, so I'll put brackets on the ones that are credits and not on the ones that aren't. And then my other deferred tax asset is $75,000, and it's non-current. And I'm going to put that in this column. So I put my deferred tax assets, so labeled, and long-term versus non-current, and current versus non-current, my deferred tax liability, and current versus non-current. Now I'm going to see which is greater. I have a current deferred tax asset of $1,000, a current deferred tax liability of $2,000. The liability is larger. The difference between the two is $1,000, and it's going to end up being a credit because the credits are larger. let's look at my non-current category. I have a $75,000 non-current deferred tax asset and a $50,000 deferred tax liability. Since that's a credit, I'll put brackets on it. $75,000 asset, $50,000 liability. When you net those, asset wins, it's bigger, and it's $25,000. So the way this is going to shake out is I'm going to have a deferred tax liability that's current, just one, and a deferred tax asset that's non-current. So when you're through netting, you can only have an asset or a liability, not both, and current or not current. So let's transfer these amounts to our balance sheet and see where we end up. Just for grins, let's put our assets and liabilities on and then put on our deferred tax amounts. We have an installment receivable for $125,000 and it was long term. So that's going to show up as an installment receivable under non-current assets in the amount of $125,000. Sorry about all the noise in the background. Somebody had too much caffeine. We have a prepaid insurance, that's current. We're going to come up and put that right here. Prepaid insurance for $5,000. Those are our two assets that gave rise to deferred tax liabilities. Here's our current one, here's our non-current one. We had two liabilities that gave rise to a difference. One was unearned revenue, and it was short term. So I'll write unearned revenue here in the amount of $2,500. And I had a non-current one, a lawsuit liability. Non-current. That's going to be the 100, got the 25, now the 187.5. So I have the assets and liabilities that gave rise to my deferred tax items listed on the balance sheet. Now, I have a current deferred tax liability I need to record, so I would write deferred tax liability under my current liability, since it's current, in the amount of $1,000 on my little worksheet above. And look, it makes sense. I have prepaid insurance of $5,000 and unearned revenue of $2,500. That nets to $2,500. The asset is bigger, and so I have a deferred tax liability of $1,000. That's 40% of the net amount. Wow, cool, huh? Let's look at the long term now. We have a liability of $187.5 versus an installment receivable of $125. The liability is bigger, so we should end up with a deferred tax asset out of it, because remember, liabilities have deferred tax assets, while assets have deferred tax liabilities. So since the liability is bigger, we know it's going to end up being a deferred tax asset. And if you net the two and take 40% of it, it will be our $25,000, and that would be shown on the balance sheet under non-current assets. So the tax is actually shown in the section that it relates to, and it is the net of the two numbers that are related to it. Hopefully that helps you understand that the deferred tax account is shown at the taxable amount, and it relates to assets and liabilities on the balance sheet that are shown at their whole amount. The $5,000 and the $2,500 are accounting basis, and when you subtract the $1,000, they're on their tax basis. Isn't that interesting? So let's finish this up with some rules. Here's the rules. Rule number 1. net the current deferred tax asset and the current deferred tax liability amounts, get one number, and show the resulting number as a current item on the balance sheet. Then net the current deferred tax asset, the non-current deferred tax asset, and non-current deferred tax liability amounts to one number and show it where it belongs in the non-current section of the balance sheet. Finally, the third one is,
That's the one blanket.
if you have a deferred tax amount that does not relate to a balance sheet account, if you have a deferred tax amount that does not relate to a balance sheet account, determine if it's current or not by when it's going to reverse. A net operating loss is a good example. It doesn't have a balance sheet account that it relates to. It's just an amount that's going to carry forward your deferred tax asset account to the future. Part of it will probably be current and used next year, hopefully, and the rest would be non-current. Well, thanks for joining me on this discussion on how to present deferred taxes on the financial statements. Hope that helped, and hey, you're almost through.